Every year, the most common thing that happens when someone completes their tax return is they look at what their refund is for this year and they compare it to what they got last year. While I understand why this happens, there are some common reasons why your tax refund this year could be quite different to last year. The first one is a difference in income. If your income is different, you can't expect just to get the same amount back as the last year. There are various reasons why your income could be different. It could be as simple as you've had a wage increase at work, and as your income's gone up, you've moved into higher marginal tax brackets where you're paying a higher rate of tax. So even though you've had more tax withheld, it might not be at the same kind of percentages of overall income, and therefore maybe your refund is reduced, or maybe it's even increased. Maybe you've got new sources of income that you didn't previously have. Maybe you've got more interest, or maybe you're working multiple jobs, or maybe you've got business income now. All of these things could impact your return because you've now got multiple sources of income. Even though you're taxed on your overall taxable income, it's obviously going to depend on what income that's made up of. This is especially true if you take on new income sources that aren't having tax withheld on them on an ongoing basis. So let's have a look. If we earn $1,000 bank interest extra that we didn't have last year, we've now got $1,000 of more income and no tax withheld on it. So if we're on that 34.5% tax bracket, we're going to pay $345 tax on this income. So if everything else stayed the same in your return except for this, you're going to get $340 less back at tax time. The second area is if you have a different amount of tax withheld to the prior year. If you earn the exact same amount of money, everything else is the same, spouse details, HECS debts, private health, but you had differing amount of tax withheld, that's going to be the difference in your return, assuming that tax rates are still the same. So have a look at your total income versus tax withheld, and this will get you an idea of, well, is that why my income and my tax return is different this year? Now, this could occur for multiple reasons. Maybe you're working multiple jobs and your overall income stays the same, but the withholding could be quite different to just when you worked one job. Or maybe you've got more sources of income that don't have tax withheld on an ongoing basis. Or maybe previously you realized you weren't claiming the tax-free threshold, so you're being overtaxed. And during the year you fixed that up, so you were starting to claim it, and therefore you've had less tax withheld on an ongoing basis, optimizing your weekly take-home pay, but it could reduce your final tax refund. So just be aware of these things. At the end of the day, the tax withheld actually doesn't impact your overall amount of tax you pay in total, but it will impact your tax refund or tax payment, because what happens at the end of the year, we look at our total taxable income, we work out the tax that's owed on that, we then look at any tax credits that apply, and after we apply that, we'll either end up with a refund or a payment amount. Now, something else you can do to better understand your taxes is to join my free email newsletter where I drop tax tips every single week throughout the whole year that helps you better understand and optimize your taxes. The sign up link is in the description to this video. I'd love to see you there. Now let's move back into the video and look at number 3, which is your HECS debt. If you have a HECS debt, it is likely going to impact your return, especially if your HECS debt is different to what was there the prior year. So maybe you've started to study and now you've got a HECS debt, and previously you didn't have one. Well, obviously your overall tax is going to be very different. Now, if you are employed by someone, you will likely tick when you do your tax file number declaration to declare that you've got a debt. So they should be removing that amount each week from your pay as tax withheld. However, it doesn't get financed until you lodge your return. That's because your HECS repayment is going to be based on your repayment income that isn't known until you lodge your tax return. Now, your repayment income is made up of your taxable income, and then it gets adjusted for a few different other things. So let's look at the table here that shows the differing amounts of income versus the repayment income rate. And you can see things quite differ as we get more and more income. Let's have a look at this example here where we earn $60,000, and that repayment income would be a 2% rate. So our total repayment would be $1,200. Now, if we increase our income, maybe it goes up to $100,000, so it's just under doubled. That rate now becomes 6% of the $100,000. So all of a sudden, our payment is $6,000. This is 5 times the amount of if we only earned $60,000. Our income definitely hasn't multiplied by 5, but the repayment has because the rates increase as your income increases. This is something to be super aware of, that your total tax you might need to pay could dramatically differ if your income is increased and push you into different brackets for your HECS repayment. Another area that commonly can impact your return is private health. So we have what they call Medicare levy surcharge thresholds. So if you are earning over these incomes and you don't have hospital private health cover, then you'll pay the Medicare levy surcharge. Now this has increased for the 23/24 year, and it has increased to $93,000 for singles and $186,000 for families. So if you are over these income limits and you don't have private hospital cover, then you will pay the Medicare levy surcharge, and that starts at 1%. And this can be quite a high tax when it comes to going from zero and going up to that. So if we earn 85,000, we'll pay 0% because we're under it. But if we earn 95,000 single, now we pay 1% of that, so it's $950. So you can see if your income previously was just under the threshold and now it is over the threshold, it can be quite a difference in your tax refund at the end of the year. The other area where private health can affect your return is the private health rebates. So you'll see here there's different tiers depending on where your income fits, which will impact how much rebate you should be getting. Now, typically, a lot of people get this ongoing from their private health fund, so it reduces the premiums they're paying on an ongoing basis. So if your income increases, though, throughout the year, or it's different to what you told your private health fund, you may have been receiving too much rebates on an ongoing basis. And then when you lodge your return, this gets fixed up and you'll owe what's called an excess private health insurance rebate. So just be aware of this. If your income does change over years, or maybe you just realize you probably put the wrong amount, let your private health fund know so they can adjust your ongoing rebates so you don't get stung at tax time. And of course, do not compare your return to other co-workers, because the chances of two people's tax affairs being the exact same is very, very small. Even if we've got two people that are in the exact same role, they earn the same amount of income, their return could be different for a number of reasons. Maybe just basically one has claimed the tax-free threshold and one hasn't. Well, that's going to impact their return. Maybe one has other income sources such as interest, or maybe they've got a small business they run on the side. That's going to impact. It could be things like spouse details, HECS debts and private health that we've talked about. Maybe they've got dependent children. There is a numerous routes of reasons why your return could be different to someone else's. What you don't want to get caught up is thinking, oh, someone at work, they got $3,000 back. When I lodge my return, that's how much I'm going to get back. One, that just isn't going to happen. The reality of two people getting the same refund is very low. And also, they may have claimed stuff that they're not even allowed to claim, and they might get an audit done and now owe all that money back. So you just want to be super careful when you're comparing with others. There's nothing wrong with asking others that are in similar roles to you what kind of things they're claiming, because then you can get an idea of, oh, hey, I actually spent money on that. I might be eligible to claim that as well. But don't get caught up comparing refunds with two people, because it's just not worth it. One thing that is worth it, though, is avoiding the common mistakes everyone makes when it comes to their taxes. As a tax agent, I put together this video of some of the most common things that I see where people go wrong with their taxes. I'd love to see you over there, and I appreciate you watching this one.